Hello everyone and welcome back to another video. In today's video, we are going to be discussing HIM stock because many of you have been asking for an updated opinion from me on what I think about the stock today. Then we are going to be discussing two stocks that I am actively researching and I am very interested in buying. I have not pulled the trigger on them yet, but these are two stocks that have been on my watch list and they are in meaningful corrections right now. So I think that this is a good time to add them to your own watch list and potentially research them on your own as well. But before we get into the video, I want to let you know that Stock Unlock is having our Black Friday sale. You can currently save 30% on a Stock Unlock subscription, and this is the largest sale that we do all year. So if you have been waiting to get a subscription or you've been waiting for a sale, there is literally no better time than right now because this is the largest saving that you're going to be able to get again, all year. But this is a fantastic platform for doing stock analysis, tracking your portfolio, analyzing stocks, getting a quick overview of a business's fundamental and financial health, even screening stocks and running discounted cash flow calculations. This is the platform that I use to do all of my stock research, and I am also directly involved with building the platform. I am a co-founder of Stock Unlock. And the second major exciting announcement is that the Stock Unlock app is now available on Apple. Many of you have been asking when the app will be available on Apple, and it finally is. And you can use the app on Android and Apple now for completely free. It's a beautiful app for tracking your portfolio and doing stock analysis on the go. I will leave some links in the description to both the Apple and the Android download, and the Black Friday sale does apply to subscriptions on the apps as well. But again, they are completely free to use, so download them, check them out, and let me know what you think of the apps. But with that being said, let's now hop into the video and start off by discussing HIM's stock today. Right away, we can see that HIM stock has been incredibly volatile historically. Back at the beginning of 2025, this was a $27 stock, and then it ran roughly 150% to start off the year, hit about $70 per share, fell all the way back down here to about $25, and then it ran all the way back up to $64. And again, the stock has just been incredibly volatile. But if we zoom in here, we can see that HIMS is in roughly a 40% drawdown now over just the past month. Now, HIMS is a stock that I also used to own. I first purchased it in December of 2024, then I was adding to my position in January of this year, but I completely sold out of my position in June for a roughly 80% gain at that time. I made a full video on my channel when I sold out of my position. I thought that the fundamentals were kind of deteriorating and HIMS was just a huge question mark and out of my circle of competence, which only became more clear as time passed. But let's take a look at HIM's most recent earnings report to see if the fundamentals are improving or if things have changed. As always, I went through HIM's most recent financial report and took screenshots of all of the highlights that I think investors need to know. So here we can see that for the third quarter of 2025, HIMS produced revenue of almost $600 million, which was up 49% year over year. The company's operating cash flows came in at $149 million, up 74% year over year. Subscribers came in at 2.5 million, which is up 21% year over year. And the monthly online revenue per subscriber was $80, which is up 19% year over year. So at face value, these are pretty strong numbers. Again, revenue is up 49%, operating cash flow is up 79%, and subscribers are up 21%. But HIMS did sell off after this earnings report, so let's continue going through it. Moving on to the next screenshot, we can see that the number of total subscribers using a personalized treatment plan is up 50% year over year and is now making up well over 50% of HIM's total subscriber base. And I do think that this is a good thing to see because HIM's entire goal is to get more people on personalized treatment plans because they become more sticky subscribers. They are less likely to churn, which ultimately means that they are more consistent revenue for the company. Moving on to the next screenshot, here HIMS shows us their outlook for the fourth quarter of 2025 and for the full year. So for the fourth quarter, they are expecting revenue of roughly $615 million, which would be up 28% year over year. Now, this outlook is in line with my own expectations, and even when I was a HIMS shareholder, it was pretty clear that they were expecting revenue to decelerate into the later end of this year. And it is very clear that HIMS revenue growth rates are decelerating because, again, in the third quarter, they just had a 49% year over year revenue growth rate. But now in the fourth quarter, they're expecting that growth rate to drop all the way down to 28%. So HIM's business is clearly seeing a pretty large deceleration. But overall, 28% year over year revenue growth is still quite strong. But here is where my first red flag starts to pop up. And it's actually in regards to HIM's full year 2025 forecast, because at the beginning of this year, Hims was projecting 2.3 to 2.4 billion dollars in revenue for the full year. However, Hims' initial revenue forecast did not include any acquisitions. And Hims has done two acquisitions this year. One was decently large and is expected to produce roughly $50 million of revenue towards Hims' full year result. And what this means is Hims' current forecast of $2.34 to $2.36 billion in revenue includes a $50 million revenue contribution from their Zava acquisition. And what this means is that without this acquisition, Hims would actually be missing their revenue or coming in right at the low end of their initial forecast. And they don't, in my opinion, make it clear that this is the case. They're kind of saying that, hey, we're going to meet our revenue targets that we set out at the beginning of the year, but they don't tell investors that that's only because they have done an acquisition this year that's boosting their revenue. And I think that this is not totally transparent. And even historically, I have said that Him CEO seems to not be fully transparent with shareholders and not give them the cold hard facts or the truth. And when I'm investing in a company, I want the management team to tell me the good and the bad because that helps me weigh the risks as well. And as an investor, you want to know what all of the risks are and the true things that are happening within the business. So this is my first red flag that they're not necessarily telling investors that, hey, we're going to hit our guidance initially, but the core business, the organic growth of the business is actually weaker this year, and it would have missed guidance without an acquisition. And if you want an example of a company doing this, go and look at Zeta. Zeta and their own outlook, I don't own the stock, but it is one that I am interested in. But they do acquisitions as well. But what they do is they show you their revenue prior to their acquisitions and how their core business is actually moving towards the targets that they set out at the beginning of the year. They have a whole table dedicated to doing it. And I think that is the right way to update your shareholders on your guidance and how the business is actually performing. And Hims simply is not doing that. All right, moving on to the next screenshot. This one shows their overall subscribers. And here we can see that their subscribers did come in at 2.5 million, which is up 21% year over year. But we can clearly see that Hims' subscriber growth rate is also decelerating in a pretty large way. In fact, I found this screenshot on X from someone who is tracking Hims' net addition to their subscribers on a quarterly basis. And we can see that over the past few quarters, Hims' net subscriber growth rate has been falling off of a cliff. And in their most recent quarter, they only added roughly 32,000 subscribers, which was the weakest quarter over the past 3 years. So Hims' overall subscriber growth is decelerating quite significantly. Let's now move on to Hims' income statement, and there's a few metrics that I want to highlight here. The first one is the gross profits. So Hims' gross profit did grow by roughly $125 million year over year, which is great to see. I do like to see that the business's gross profits are growing. However, last year in the third quarter, we can see that the company spent $182.3 million on marketing. But again, they only increased gross profits by $125 million, which means that the gross profits did not grow by the net amount of money that they spent on marketing. Now, don't get me wrong. I do think that Hims' marketing expenses are still very effective and they're clearly growing the business. But as I have shared previously on my channel, Hims used to spend, I'll just give you an example. Hims used to spend $100 million on marketing in the prior year quarter, and it would grow the gross profits by over $100 million. So they were getting a very high return on their marketing spend. Again, they would put in $1 of marketing spend, and it would result in something like $1.50 of gross profits over the next year. That is no longer happening, which means that Hims' marketing dollars are not as effective and they're not growing the business as much. And that is just what the numbers are telling us here. The numbers don't lie, and Hims' marketing expenses are clearly not being as effective as they once were. This is another screenshot from Cedar Grove Capital Management, and they track the Hims' quarterly total marketing expenses divided by the net subscribers added. And what you ideally want to see in the screenshot is the number going down, because this is essentially the amount of money that Hims has to spend for every new subscriber that the company generates. And we can see that since the fourth quarter of 2024, Hims' net dollars spent to acquire a new subscriber have been growing significantly. And in the most recent quarter, it was at $7,255. This is not a great trend to see. And once again, this suggests that Hims' marketing spend is not producing as much of a return for the business. Now, I also want to show you this screenshot that I found on X from Crossroads. And here they say, I'm still going through Hims' earnings, and I'm failing to find the breakout of X GLP-1 revenue, which is the core revenue of the business. like they did on the 10Q last quarter. Is this missing? Then Him's House said, yeah, it wasn't broken down this time. And then Crossroads also replied, I don't love that. Now, as a former shareholder of Hims, this stock was seeing a ton of noise around the GLP-1 revenue that the business was generating. Because when they introduced GLPs in May of 2024, their business saw a massive acceleration because so many people were signing up to the platform and buying GLP-1s. And what Hims used to do is break down how much of the revenue was coming from GLPs on a quarterly basis. They didn't necessarily do this in the most transparent way, which was another red flag for me. They kind of gave you like, here's some numbers, then later on they would give you some more numbers, then you could do some math and figure out how much non-GLP revenue the business was actually generating. But I viewed, and I think investors view, the non-GLP revenue as the actual core revenue for the business. So the fact that Hims has stopped showing both GLP revenue and non-GLP revenue is raising another red flag for me, because this is the first quarter where they don't even address it at all. Now, this could be the business wanting to move away from GLPs as a whole and wanting to make the narrative on the stock less about GLP-1s overall. But for me, I still do think that it is a net negative because it is one of the things that the market clearly wants to know. It's one of the things that investors clearly want to know about is how is the GLP-1 revenue doing and how is the actual core business doing. So in my opinion, the reason why Hims would exclude this number for the first time since they started selling GLPs is probably because their core business is weakening and seeing a large deceleration. I think that if their core business was doing extremely well and accelerating and growing and remaining on track, they would want to highlight that to the market. And I think that Hims would say, hey, look, we are not a GLP-1 story. Our core business is doing fantastic and it is still growing very well, which is what they used to do. But the fact that they're not doing that now, again, is a large red flag for me. And I also think that it is another example that the business is not being totally transparent with their shareholders. I think they're trying to hide that the business is actually weakening. So let's head over to Stock Unlock now and take a look at Hims' total number of subscribers. And I think that by zooming out all the way to 2021 really gives us a better view of how much the subscriber count is decelerating. They were growing subscribers incredibly well up until about the fourth quarter of 2024. And now so far in 2025, they've only added about 200,000 subscribers, which means that Hims has only grown their subscriber count by roughly 10% so far this year, which again is a large deceleration to the business. So overall, I think that there are some red flags popping up with Hims, and I think that there's some clear indicators that the core business is really slowing down, and maybe the momentum for this company is stopping. Couple that with the fact that I don't think the business is being totally transparent with their shareholders, and they're kind of trying to mask that their business is weakening, doesn't really paint a good picture of a stock that I want to own, because one of the key things that I look for in a business is a strong and transparent management team. And if that doesn't exist, then the stock is not a buy for me. So no matter how low Hims stock gets, it's not really a stock that I care to add back to my portfolio, because over the past 6-ish months since I sold the stock, I think that a lot more red flags have been popping up. And overall, the thesis for me just completely changed. So my final conclusion on Hims is that it's not really a stock that I'm looking to add back to my portfolio, no matter how cheap the stock gets, just because management is a huge question mark for me. And I do think that there are some real signs that the business is starting to deteriorate. So with that being said, let's now move on to the two stocks that I am actively researching and am very interested in. And the first stock is Sea Limited. Sea Limited is a technology giant based in Singapore that operates a vast consumer internet ecosystem across Southeast Asia, Latin America, and other high-growth markets. The business is split into three main parts: digital entertainment, which develops and publishes widely popular online games like Free Fire; e-commerce, which is the dominant mobile-centric online shopping marketplace; and digital financial services, which provides digital wallets, payment processing, consumer lending, and banking services. Sea Limited is actually very similar to Mercado Libre, but it is mostly located in Southeast Asia. Its largest markets are Indonesia, Thailand, Vietnam, Singapore, and Malaysia. And why I am bullish on this is because Indonesia, Vietnam, and Thailand are all growing economies that could provide massive tailwinds for the company for decades to come. Now, if we take a look at Sea Limited's stock price, we can see that it has been extremely volatile historically. From 2017 to it looks like October of 2021, the stock produced a 23x return. However, from the peak in 2021 to the pit here in 2024, the stock then saw a 90% decline. So this was one of the COVID winners. The stock saw a massive return during that period, but from 2021 to 2024, the stock saw a huge drawdown. However, from January 2024 to its recent peak here in September of 2025, the stock once again was up 450%. And since that peak, it is now back down 30%. So again, this has been an incredibly volatile stock, but this recent 30% correction is actually starting to make the stock look quite interesting to me. So I went through Sea Limited's most recent earnings report, and I have a few screenshots that I want to share. The first one is that its e-commerce revenue. So in the most recent quarter, its e-commerce revenue grew 35% year over year and 14% quarter over quarter to 4.3 billion US dollars produced in the quarter. Its digital financial services loans outstanding increased by 70% year over year and 14.6% quarter over quarter. So Sea Limited's loan portfolio is growing extremely quickly as well. Then lastly, its digital entertainment bookings, which is the gaming revenue, was up 51% year over year and 27% quarter over quarter. So it seems like all three business segments of Sea Limited saw really strong growth in the most recent quarter. But just like with Mercado Libre, its stock sold off, and it seems like the market is not bullish on this earnings report for some reason. And I think it's because Sea Limited's operating income and net income did decline on a year over year basis because the company is making investments back into the business. And if you've been watching my channel for some time, which company does this sound like? Where every time the company reinvests back into itself, sees some short term margin pressure, the stock sells off. Well, that is Mercado Libre. And the more that I learn about Sea Limited, the more and more similarities I see between this business and Mercado Libre. And since Mercado Libre is the fourth largest position in my portfolio, and I have been very vocal that I am bullish on that business, it's only natural that I would then become interested in Sea Limited as well. But let's continue on through my screenshots now. And here we can see that the revenue for Sea Limited was $6 billion in the most recent quarter versus $4.3 billion in the prior year. This is year over year growth of roughly 40%. So Sea Limited is growing extremely rapidly. Gross profits also came in at $2.6 billion, up roughly $500 million year over year. However, as I just said, operating income did decline on a quarter over quarter basis, and net income also declined on a quarter over quarter basis. Although the numbers are still up massively, while they more than doubled on a year over year basis. So I think that the quarter over quarter decline to operating and net income is the reason why the stock sold off in the most recent quarter. But when you see that the top line is growing so well across all major business segments, I think it's a pretty clear indicator that the business's investments are actually paying off and growing the business rapidly. So let's head back over to Stock Unlock really quickly. And here we can see that from 2018 to today, the company has compounded its revenue by roughly 61.5% annually. However, we can see that there was this period from roughly 2022 to 2023 where the revenue was not really growing all that much. But if we go and take a look at the KPIs here and look at the digital entertainment revenue, this once again is the gaming revenue for Sea Limited, and we can see that it did peak here in the first quarter of 2021, and then it was cut by more than half all the way down here to the third quarter of 2024. And this acted as a massive headwind for the company's overall revenue growth. But what Sea Limited was doing during this time was using the profits from the gaming business and plowing it into growing the e-commerce and fintech revenue. And here we can see the e-commerce revenue has been growing incredibly well and hit an all-time high of $15.3 billion in the trailing 12 months as of the most recent quarter. The fintech revenue is also absolutely exploding and hit $3.4 billion in the trailing 12 months and increased by roughly 15% quarter over quarter. And the growth of the fintech and e-commerce businesses is why Sea Limited's revenue started to re-accelerate. And the gaming segment of the business now makes up around 10% of the company's overall revenue, which basically means that Sea Limited is no longer reliant on how the gaming revenue and profits are doing. Because back in 2021, the majority of the revenue was from gaming, but as we saw, the gaming revenue declined massively from 2021 at the same time as e-commerce and fintech revenues have absolutely exploded. So I would say that this is no longer really a gaming business. It has a gaming segment, but it's really an e-commerce and fintech business now. which again is a lot like Mercado Libre. So I pretty much view Sea Limited as the Mercado Libre of Southeast Asia. And I'm also bullish on this region of the world because the economies over there are developing and growing extremely quickly. And as those economies continue to grow, I think that Sea Limited will continue to grow with them. And it seems like Sea Limited is doing a very good job growing with those economies and actually is taking market share over there as well. E-commerce, fintech, and digital payments are all industries that I am very bullish on, especially in emerging markets. And it seems like Sea Limited would be one of the best ways to gain exposure to those industries in those economies. So that's why it is on my radar. I haven't pulled the trigger on this one quite yet, but I could see Sea Limited being added to my portfolio at some point in the future. The main issue that I have is, Sea Limited is very similar to Mercado Libre. So it's just a question of, do I want to use that money to buy more Mercado Libre or diversify a little bit and add Sea Limited to my portfolio? That's kind of the battle that I'm having in my head. And I'm going to continue to research this one a little bit more. So I'm going to continue researching this one, but if I do pull the trigger, then I will definitely let the YouTube channel know. All right, let's now move on to the second stock that I am actively researching and thinking about adding to my portfolio. Again, this is not one that I have purchased yet, but I think that it looks extremely high quality and compelling today. This stock is nem.de or Nemetschek. Nemetschek is a software company that provides essential digital tools for the entire lifecycle of buildings and infrastructure, from initial design to final construction and long-term operation. Their primary business is offering software used by architects, structural engineers, and construction teams to design, visualize, plan, collaborate, and manage physical assets like buildings, bridges, and tunnels. Now, if we take a look at Nemetschek, we can see that this was a 56-cent stock all the way back in 2009, and it is a 93 euro stock today, which means that the stock has produced well over 100x returns over the past 16 years. The share price performance has been nothing short of incredible. And if we zoom in here, we can see that the stock is currently in a roughly 32.4% correction, which I do not necessarily think is justified. And this correction is because Nemetschek is in the software industry. And as I'm sure many of us know, the software industry has seen a lot of selling in the stock market recently, with fears that AI is going to disrupt these types of businesses. However, I want to show you a couple of screenshots from Nemetschek's Q3 earnings report. And here we can see that they grew revenue by 20% year over year. They also saw 46.4% growth in their subscription and SaaS revenue, 26.4% annual recurring revenue growth, 33.9% EBITDA growth, 40.7% growth in their earnings per share. Then they say further strengthening of AI expertise through the acquisition of Firmus AI in the third quarter, and the executive board reconfirmed previously raised revenue outlook and EBITDA margins for the full year of 2025. Then further down, the CEO said, "Our AI-powered product portfolio centered on agentic AI and other new AI features, including the acquisition of Firmus AI in the third quarter, make our solution portfolio even more attractive and take it to the next level. The construction industry is entering a new season of intelligence, and we are excellently positioned to benefit from this development." Then in the Q3 conference call, the CEO said this, "We are deeply convinced that AI represents a tremendous opportunity for us as a vertical software company that is deeply embedded in the processes and workflows of our customers. Of course, artificial intelligence also plays a key role in optimizing our internal operations. To further accelerate our pace of innovation, our deep domain expertise and close customer relationships enable us to develop cutting-edge AI products and features." So what I'm gathering from Nemetschek's third quarter 2025 results is that they are deeply convinced that artificial intelligence is actually going to benefit the business by allowing them to create and offer new products to their customers and also increase the efficiencies of their business. Nemetschek is also seeing tremendous growth of over 20% to their top line revenue, 26% annual recurring revenue growth. They also saw their EBITDA grow by over 33% and their earnings per share grow by over 40%. So the margins seem like they are expanding for this business. In fact, if we head over to Stock Unlock quick, we can see that Nemetschek's free cash flow margin is in fact expanding, and it is sitting at 32.9% in the trailing 12 months now. We can also see that Nemetschek is trading for around 28 times free cash flow today. And I am zoomed out all the way to 2016 here, and we can see that its average has been 41 historically. Its previous low was around 26 times free cash flow in November of 2022, So it's not quite as cheap as it was during the massive tech sell-off during 2022, but relative to how this stock has historically been valued, it is looking quite attractive. So let's now take a look at the free cash flow growth to this business. And we can see that since 2016, the cash flows have compounded by roughly 22.7%. And the free cash flow growth has actually been accelerating since about 2023 and hitting an all-time high of 381 million euros in the trailing 12 months now. What I also really like about Nemetschek is their shares outstanding simply does not grow. If we zoom all the way out to the year 2000, we can see that their share count has remained consistent this entire time. So I view Nemetschek a lot like a Constellation software type company. This is a vertical market software business that's consistently growing its revenues and its free cash flows by over 20% annually, and it is not diluting shareholders at all. Its share count has literally not grown in over 25 years now. This business also has significant insider ownership, with over 50% of the shares owned by insiders. So there is a massive alignment with the insiders of this business and the public shareholders. There's also absolutely zero stock-based compensation going on, which is why the share count is not growing, which is identical to what Constellation Software does. So I think that Nemetschek looks like an incredibly high-quality business that is actually benefiting from artificial intelligence. The stock is in a 30% plus correction right now. It's selling for one of its lowest price to free cash flow multiples over the past decade, and it is selling significantly below its historical average price multiples. That is why I am so interested in the stock. I will admit that a 28 multiple is higher than I usually pay for a business, but this is truly, when I take a look at the fundamentals here, it is truly one of the highest quality businesses that I have seen in the market. And if the business can continue to compound by over 20% per year, and if artificial intelligence does truly benefit the business, then I think a 28 multiple is very fair for Nemetschek. So this is a stock that is on my radar. I am continuing to research it more and more. And this is one that I could see myself adding to my portfolio around its current price. The recent sell-off in a lot of quality stocks in the market has opened the door for these types of businesses to look attractive here. So I will let you know if I do end up buying a position in Nemetschek, but it is one that I simply think looks awesome, and I wanted to add it to your radar as well. But before we wrap up this video, I do want to remind you again that the Stock Unlock app is now available on all Apple devices. So if you want to check it out, again, it's completely free to use, then go and download it from the Apple App Store. Also, our 30% off Black Friday sale over at Stock Unlock is happening right now. So there is no better time to pick up a subscription to Stock Unlock, which is the platform that I used throughout this entire video to analyze these stocks, look at their price multiples, look at their fundamentals, look at their KPIs, and it offers so much more. So again, if you want to go and pick up a subscription to Stock Unlock, there's no better time. Go and save 30%, and I will leave a link at the top of the description. But with all that being said, thank you all so much for tuning in. As always, I truly do appreciate it, and I really hope to see you all again in my next video.